Hi, and welcome to Size and Style 2.0, New Approaches to Traditional Investment Strategies, the latest installment of the IndexUniverse webinar series. I'm Matt Hogan, President of ETF Analytics and Global Head of Editorial for IndexUniverse, and I'll be your host for today's webinar. I'm pleased to be joined today on the call by true experts on style investing. Rolf Agather, Managing Director of Research and Innovation for Russell Investments, and Christopher Humer, ETF Investment Strategist for Northern Trust. The format of today's webinar is simple. For the first 40 minutes or so, Rolf, Chris, and I are going to present three distinct viewpoints on this concept of size and style investing 2.0. We're going to lay out some of the areas where investors and innovators are pushing the boundaries, breaking the style box, as it were. Then, following our presentations, we'll have 20 minutes of audience Q&A, where you can ask questions of us. We anticipate a lively Q&A session. As a participant in this webinar, you're invited to ask questions of me and my panelists using the Q&A tool at the bottom right of your webinar browser. Please don't wait until the end of the webinar to ask questions. Ask them throughout the webinar as they occur to you. We'll collate the questions and answer as many as we can during the Q&A session at the end. We always get asked by participants, so I'll say this up front. A recorded version of this webinar, along with the slides, will be made available on IndexUniverse.com a few days from now. As a participant in this webinar, we will send you an email alerting you when those slides and that recording is posted. So let's get started. The case for diversifying across different size buckets has existed for decades. It's been built more or less on two academics' findings as old as the hills. The first, that small-cap stocks tend to outperform large-cap stocks over time. And the second, even when they don't, small-cap stocks and large-cap stocks at least tend to perform differently, creating a diversification effect when small-cap stocks are added to a portfolio. There are wide-ranging debates for the reason for why the small-cap performance premium exists. Some argue that the smallness of companies makes them vulnerable, creating added risk that must be rewarded. Others say that the absence of Wall Street analyst coverage on small-cap stocks creates uncertainty in those stocks, justifying a premium. Still others say that because these stocks are less liquid, that illiquidity itself deserves its own premium. Some have even argued that the concept of a small-cap premium is based largely on returns from the high inflation days of the 1970s, something to keep in mind, perhaps, in the years to come. But regardless of why people think the small-cap premium exists, they do think it exists, and it has stirred an industry of small-cap indexes and small-cap investment, both active and passive. The second fact, that small-cap stocks perform differently than large-cap stocks, has been perhaps even more critical than any outright outperformance in small caps in driving interest in size and style distinctions. As you can see here, over various time periods, there have been varying levels of diversification benefit on moving between large and small cap stocks. Correlations were high during the boom years of the 80s and 90s, but less so at the beginning of the 2000s. If you fast forward to the most recent volatile periods, however, those diversification benefits seem to have disappeared. And that's a big reason why we're here today, to try and answer the question of whether this size and style-based investing still works for you as an investor. Over the last few years, the correlations between large, mid, and small-cap stocks have been virtually perfect. They go up together, down together, and sideways together. And I note that we're looking here at 5 years of data. This is not a short statistical anomaly. Instead, what we're seeing is a period where exogenous factors like the risk-on, risk-off trading, the liquidity crisis, the housing bust have dominated markets. And during these macro-driven markets, correlations of many asset classes rise towards 1, and large cap, small cap seems to be no exception. The second classic division in equities that's been driven home by academic finance is the distinction between growth stocks and value stocks. The famous Fama French model is essentially based on these two ideas, the size premium and the value premium. But we see largely the same story here in growth versus value that we saw in small versus large. Just like the large-small division, we saw the correlation benefit between dividing these two parts of the market actually increase over the years, from 0.93 in the 80s to a correlation of just 0.66 in the pre-crisis aughts. And then, you probably know where this is heading. The craziest of the last 5 years hit, and boom, correlations again rose to near perfect. It is in this market that investors are looking for new ways to capture distinct patterns of returns, groups of stocks that can do what small cap stocks used to do, or what value stocks used to do, both beating the market and zigging when the market zags. And that's the primary thing we want to cover in today's webinar on Size and Style 2.0. The other thing we want to look at is how those distinctions are made. This chart compares the performance of 3 broad-based U.S. mid-cap indexes over the past 10 years. And you can see while the performance tracks a similar pattern, they actually end up in considerably different places. Here's a table version of that to hone in on the question a little bit. Why is there a 20% difference in return among competing mid-cap indexes over the past 15 years? The answer, of course, is that these are very different mid-cap indexes. The Russell Mid-Cap Index stretches from the 200th largest stock down to number 1,000, and the S&P Index starts much smaller. In fact, the weighted average market cap of securities in the S&P Index is just $4 billion compared to $8 billion for the Russell Index, therefore creating a more pronounced small cap effect. How you choose between these indexes obviously matters. We see a similar discrepancy in the debate over style. Here we've highlighted the factors that 4 major index providers use to separate growth from value. You can see some consistency. Price to book, the original arbiter of value stocks, remains a constant in all methodologies. But there's also considerable debate about what else to consider. Here's my take on the different approaches, but our panelists are going to have their own answers to these kinds of questions. On the growth side, of course, there's even more debate. And of course, the end portfolios that result vary significantly from one another. We'll talk a little bit today about the importance of comparing different size and style indexes, and also, critically, what is the best way to capture the risk premia associated with both the size and value effects. But the biggest thing we want to do today is help step outside the style box. Or to put it another way, are the 9 style boxes really the best way to divide the market? A torrent of questions can follow. Is size really as big a driver of returns as volatility? Can beta, the original and often forgotten factor in Fama French's 3-factor model, be a more valuable and consistent driver of returns than the other two? Can you capture momentum the way you capture small cap exposure? How does dividend exposure factor into all these things? And what's the best way to tap into all these various factors that hover around the size-style spectrum? After all, what investors are trying to do with size and style investing is capture distinct patterns of return, things that zig when markets zag, and groups of stock that exhibit and capture unexploited risk factors. So today we're going to take a look at a couple of different approaches to doing that in the modern age, hearing from 2 real experts on the space. First, Rolf Agather from Russell, and then Christopher Humer from Northern Trust. And with that, I'll turn it over to Rolf to kick things off for us.
Well, thank you, Matt, and thank you for all the participants who are taking the time to listen to this presentation today. I think Matt's introductory comments are a great way to set the stage for the discussion that ensues. As he mentioned, I am managing the team of researchers that develops new index methodologies and enhances existing indexes within Russell indexes. And so I think we do have a unique first-hand perspective of not only what's transpired, beginning from the creation of the first style indexes back in the 80s, but also some of the newer developments and innovations that are coming to market, hopefully to the benefit of investors. And I think it's interesting that as much as we're going to get into detail, that we do try to keep something in mind in terms of, ultimately the objective of all index providers is really to come up with robust and unambiguous frameworks, really to try to create distinct segments of the market. So as Matt indicated, potentially sometimes segmentation isn't necessarily always distinct, and from a diversification standpoint, that potentially can be damaging to investors. So for us, it's always about trying to recognize distinct segments of the market, distinct sets of stocks that exhibit unique behavior, so that investors can combine things together to create the diversification benefit. I also think it's interesting that even though this is an index discussion, you'll notice references to alpha as well as beta. And I think it's another key point is as you think about the desire to segment the market, that really implies that there's an active management decision going on there. Obviously, a truly passive investor has no need to segment the market. They would simply invest in the total market portfolio. So I think as we talk about the evolution of size and style segmentation, it's important to recognize that ultimately this is a way for us to help investors make active decisions or potentially to evaluate active decisions that they've delegated to others. And ultimately, again, the goal of any index is really to come up with the most accurate and robust segmentation of that market so that investors can implement those decisions. Now, any good history professor will tell you that you really can't talk about where you're going until you talk about where you've been. So I'm going to first start out just talking a little bit about history, thinking about what really drove some of the initial work on size and style. We'll then do some comparisons of some of the indexes that are out there in terms of their methodology and some of the resulting performance differences. And then finally, I'll talk about some of the newer innovations that Russell is working on that we think will have a significant impact on the size and style dimension. So the timeline I'm showing here, I won't spend a lot of time on this, but really if you think about it, the index industry is a little over 100 years old. Starting with the creation of the Dow Jones Industrial Average in the late 1800s, all the way through recent times where, as we know, ETFs, which are primarily based on indexes, those assets now exceed $1 trillion. And this is something you can talk about in a lot of different contexts, but I think for the purposes of this discussion, if you think about it, the early years was really the era of indexes as measurement tools. So primarily the goal of indexes was enabling better measures of the market. In particular, the S&P, the Dow Jones were all attempts to better measure the performance of U.S. stocks. When Russell created the style indexes and the Russell 3000 in the mid-80s, that again was an expansion of this attempt to come up with better measurement tools to represent these asset classes, as well as to provide benchmarks for active managers. But with the launch of the Vanguard Index Trust in the mid-70s, and then again with more recent events, with the advent of the ETF industry, clearly the index is now seen more as an investment strategy and an investment vehicle in and of itself. So the more recent era in terms of the index evolution is really one of thinking about indexes and this notion of segmenting markets so that investors really can implement specific investment decisions. So just going back and looking at the advent of the early style indexes, just drilling a little bit more into the timeline. So if you go back to what was happening in the early to mid-80s, you really had kind of a trend being set within the industry. Basically, ERISA had been passed in the 70s, which really started the process for primarily defined benefit pension plans having to think about the way they invested in a much more disciplined way. So with ERISA, you now had an increasing amount of specialist active management. So potentially where pension funds had their assets managed on a balanced basis by a single bank or a single manager, you now saw increasingly that active managers were starting to specialize. So particularly in the U.S. equity or broader equity categories, you started to see specialization among managers in terms of things like large cap, small cap, growth, and value. And so Russell, as well as other consultants, as they were evaluating these investment managers on behalf of their institutional clients, were able to recognize these distinctions within the active management community. But the problem was there really weren't any good benchmarks, at least based on today's standards, with which to measure those active managers. You really didn't have a set of benchmarks that were objectively constructed, that comprehensively represented the market, as well as represented various segments within that market. Another key concept that Russell pioneered, generally indexes at the time were not float adjusted. So to the extent that a portion of a company's shares weren't really available for investors, it was important that we don't recognize that or don't account for that in the index. Otherwise, you could create a price impact on that particular stock. So you really had the active management community really starting to take shape in a much newer form, and you didn't have really indexes to go along with that. I think it's also important to note that just even in terms of the performance environment, there was a strong incentive both on the asset owner side as well as the asset manager side to have better benchmarks. So this particular chart is just showing the median active manager performance across the small cap active manager universe and the large cap active manager universe. So as I mentioned, as part of Russell and other consultants' work in manager research, you would generally collect returns and classify those according to the manager's style, and that way you could examine the relative performance of different groups of managers. And so what you'll see here is, particularly in the period of 1980 through 1983, generally, on average, small cap managers were doing far better than their large cap manager counterparts. And recognize that potentially, to the extent a benchmark was being used, both large and small cap managers were being compared to the S&P 500, which primarily was a large cap benchmark. So from an asset owner perspective, you had a situation where potentially a small cap manager was seen as delivering a substantial excess performance over the benchmark, but it wasn't because they picked better stocks. It was simply because they were allocated to the small cap asset class. They actually could have been a very poor stock picker within the small cap asset class, but simply because they were in that better performing asset class, when compared to the wrong benchmark, they would have been given credit for that. What's also interesting is Russell launched the Russell 2000 in 1984, and that probably couldn't have been a more fortuitous event given to the extent that really asset managers were ultimately the end consumers of that information. Because in 1984 and 1985, asset managers in the small cap space began to underperform their large cap brethren, in which case they potentially now saw the need to have a better benchmark. They would want to have a more fair comparison for their performance. Particularly in 1984, if the average manager performance was negative, you were going to be compared to the S&P 500, whose performance was potentially positive. So clearly in the early to mid-'80s, both the industry dynamics as well as just the performance environment was driving a strong need and a strong desire from both asset owners and asset managers alike. Now, I think it's also interesting that when we highlight at the time, when Russell first created the large cap and small cap indexes in 1984, and then even the styles later on in 1987, there was really more art than science. So if you think about it at the time, there were no pre-existing benchmarks in that space. So as opposed to today, if a new provider comes to market and creates new style benchmarks, they have the advantage of being able to compare to existing products in the market. So they have a way of differentiating or highlighting what they hope are potentially relative advantages to existing products. In the mid-'80s, you didn't have that going on. There was really no pre-existing benchmarks to compare to. So for Russell, we really had to look for other ways of describing what it meant to be a good benchmark. And so as I indicated earlier, you definitely had observations of manager behavior. So based on looking at like managers, you could identify that large and small cap managers were behaving differently. They truly were choosing from different pools of securities. That was fairly obvious. But there was overlap. So potentially, it was clear that, large cap managers were really selecting beyond just the top 500 largest stocks. They were actually dipping down quite a ways on the capitalization spectrum. Similarly, small cap managers who tended to buy from the smaller companies would hold on to their winners. So in some cases, you could see small cap managers holding stocks that were increasing in size and that would have overlapped with what we saw in large cap manager portfolios. Now, given that Russell wanted to divide the market in a very unambiguous way, you are presented with a problem. Where do you draw the line? Again, you have no existing benchmark to compare to. You have this case where there's overlap, but you really have to think about this more as an art versus a science task. And so I think one of the driving factors was really to think about not only accurately representing the opportunity set for the managers, but as much as possible trying to keep that simple. So, the notion of 1 + 2 = 3 we thought was a fairly simple construct. It was also fairly accurate in terms of its depiction of the opportunity set for large and small cap managers. And so that's really just a little bit of history about why the line was chosen in that space. I think as much as it's tempting to say that large cap managers only pick from the top 1,000 stocks and small cap managers only pick from the bottom 2,000 stocks, that's tempting to say, but the truth is that there is some overlap there, and it's only through understanding that you can come up with reasonable distinctions between large and small cap. Another point I would make is, the Fama French research, which did a more quantitative analysis, basically confirming the existence of the size effect and the style effect, came out, I think, in 1992. So it wasn't until 5 years later that you actually had a lot more of this quantitative research and quantitative evidence that identified what active managers potentially already knew. So just maybe now looking forward today, so what you end up with is potentially different providers having different methodologies. So I think Matt did a great job, highlighting that. Potentially you do see different performance patterns, which are largely a result of differences in methodology. So this chart really, highlights, especially in the size dimension, what we're really trying to accomplish. So if we start out thinking about the broad U.S. equity market, which we would represent with the Russell 3000, basically covering 98% of the available U.S. equity market cap, we can show the distribution in terms of size that would be held in the broad market. So it ranges from the largest company, Apple, of about $500 billion, to the smallest company, which is about $100 million. We then segment that into the familiar Russell 1000 and 2000, and that break point, at least in the more recent times, is right around $2 billion in market capitalization. So at the reconstitution in June, Russell does divide the broad market index into two discrete, non-overlapping indexes. The idea here is we want to get a more pure representation of what we think is large cap and what we think is small cap, again, to provide that more unambiguous framework for people to either make active decisions or evaluate those decisions. Moving to the right, we can then show a comparison of what other indexes look like based on their methodologies. Now, we've included the Dow Jones here. Obviously, that's probably the most widely recognized index in the world, but by and large, it's not really used by institutional investors or individual investors in terms of looking at their portfolios. It's definitely a good barometer for people to look at on a daily basis, looking at the news channels. And there is some historic context there, so we know that a Dow level of 12 or 13,000, what that means relative to history. But by and large, most disciplined investors don't use that to benchmark their portfolios. Then comparing to another popular index, we look at the S&P 500, which generally has the same breadth of coverage in terms of the largest and smallest company, but because the S&P 500 is sampled, it won't necessarily include every company in that range, whereas the Russell 1000 will generally include all companies that meet certain investability requirements in that large cap spectrum. S&P will take a more sampled approach. Perhaps the most telling difference then is when you start to look at the small cap space. So the S&P 600 small cap index does tend to hold larger companies than the Russell 2000. And in fact, those companies will have size characteristics that are similar to potentially some of the smaller companies in the S&P 500. Now, there's obviously reasons why S&P does this, and probably don't have the time here to get into that, but it is important to recognize that because of some methodology differences, you will see some of this overlap potentially in other providers' schemes. And there's obviously reasons for that in terms of what they're trying to represent. And so I think what's important to note is this will then start to drive some of the performance differences that we see. Now, looking at large cap space, because these companies are so large, one of the first things you'll notice is it's generally not, you don't generally get as large a difference in the large cap space when you start to compare certain characteristics. So just looking at the bottom two rows of this table, you can see that there is some distinction between the average weighted market cap between the Russell 1000, the S&P 500, and then the MSCI large cap index. But these are still pretty big companies. So even though you've got a gap of about $14 billion in average capitalization between the Russell and the S&P, these are still fairly big companies in terms of their average. Now, if you look at the market cap range, interestingly, both S&P and MSCI potentially hold smaller companies in their large cap indexes, but their weighted average is still dominated by some of these larger, more mega cap companies. As a result of that, when you look at the top two rows, you'll notice that at least for the latest 1 year return in standard deviation, you really don't get dramatically different results. Because the largest companies within everybody's large cap index truly dominate the performance, it's only if you have a very significant difference in those bottom, more mid-cap type companies that you'll see a divergence in the performance within the large cap index series. It's a very different story in small cap. So in this chart, we're actually showing the difference in performance between the Russell 2000 small cap index versus the S&P 600. So not only do you see there's potentially a distinct performance pattern over time, it can go in opposite directions. So there are a number of years where potentially the S&P 600 will outperform the Russell 2000, and there's other years where it will do the opposite. So I think this is really where people need to focus and understand that some methodology differences will be characterized by fairly substantial performance differences. So for example, in 2003, you had over an 800 basis point difference in performance between two indexes that by name are trying to measure the same thing. I think another comment I would make here, I think it's important, I think it does concern Russell from time to time that the inference here is that, well, the best index is the one that performs the best. So in this case, it appears that the S&P 600 outperformed the Russell 2000 in a variety more years over this last period than it underperformed. And I think we really think investors need to be educated that the best test of an index is how well it measures the asset class, how well it measures the particular segment or factor that it's been designed to measure. We shouldn't be thinking about measuring or evaluating indexes simply based on their relative performance over any given time period. Now, I focused a lot of this discussion in terms of differences on the capitalization side. We won't have time to do a more elaborate discussion on style, but I do want to highlight, very similar to large and small cap, where Russell is evaluating growth and value managers. So in this chart, we actually show in the large cap space what the median performance would be for growth managers and value managers. And I think, as Matt noted, potentially in more recent years, the correlations of these two different styles of investing have drawn very close. You potentially aren't seeing as big a performance difference, at least in terms of the absolute return between these styles. But clearly, there are periods, back in time where you will see some fairly distinct behavior among growth and value, some very different performance differentials. And as I've highlighted with the size indexes, differences in methodologies will then potentially produce different results in the style indexes. And so just highlighting that, again, just looking at a summary of the methodology for the Russell style family, the S&P style family, and the MSCI style family, one of the things you'll see is, in general, there are some similarities in terms of the principles. So generally, we're all using some sort of a multi-factor approach. Generally, we're all using some sort of a method by which companies can be classified either as pure growth or pure value or some blend of the two. Potentially, then, there is some differentiation in the way that we do that. But basically, most index providers today acknowledge that when you're looking at the growth and value dimension, it is important to allow companies to have a weighting in either the growth or the value component, which is what Russell established in 1987. So potentially the biggest difference is on the style variables. So again, I won't go into each of these individually, but what you'll notice is that of the three providers, Russell uses 3 variables, 1 for value, 2 for growth. S&P uses 6, and MSCI uses 8. And again, if you actually go and look at the construction and methodology documents from these providers, there's reasons why people generally look at very different variables. Again, I don't think this is the forum to have that discussion, but I think it is important for investors to understand the reasoning behind why certain variables are chosen and to recognize that that can generate very different performance between the two. So that's enough history. I think now it's important to just briefly touch on some of the new trends with respect to size and style. So the first one really came out of our work when we created our global index in 2007. And the real key here is, as we start to think about dividing the market by large and small or dividing the market by growth and value, we are taking a global relative, what we call a global relative approach. This is distinct from the previous one, which would be country relative. So in the global approach, Russell's going to assign a consistent capitalization break across countries, whereas a country relative approach would assign a different break point within each country. And so what you'll notice on the bottom of this chart is you end up getting a very different definition of the break point between large and small on a country-by-country basis, whereas for Russell, that's going to be consistent across the globe. We do something similar in style, such that if you look at the top, you won't expect each country within the Russell Index to be 50-50 growth and value. You will be able to see something that we think is much more informative, where certain countries, such as China, actually have a predominance in either growth or value versus New Zealand, which actually is predominantly value. And this is particularly significant in emerging markets. So in this chart, if you looked at the difference in, say, a country like Taiwan, where in a traditional country relative approach you would assign basically the bottom, say, 12.5% of the overall Taiwanese market to small cap, by a global relative standard, it's actually much higher. Taiwan happens to be populated with a lot of much more newer, more smaller companies, and therefore, if you actually look at the distribution of capitalization in Taiwan, it's really more heavily weighted towards smaller companies by a global standard. The other new development in style is what we call the stability dimension, and we really are describing this as an extension of the traditional two-dimensional style box. So most people are familiar with large, small growth value, and now we're suggesting that there's this new distinct dimension that we call stability, and really the two sides of that dimension are dynamic and defensive. So I think most people would be familiar with right now the concept of low volatility. And for Russell, for reasons I'll describe in a minute, we really think that the way of looking at the market as being defensive is a much more robust and thoughtful way to get access to this low volatility phenomenon. We also have a lot of research that talks about how active management potentially is driving the tilt in many investors' portfolios towards more dynamic stocks, and we think it's important for investors to be able to understand those tilts in their portfolios. So what does defensive or dynamic indicate? Well, like I said, it's definitely looking at measures of volatility, but ultimately we're trying to get at some measure of company risk. And I think it's important to acknowledge that volatility really is a proxy that is commonly used to think about company risk. But it's not the only way we can think about that. So I think it's important from our point of view that as we're trying to create indexes that are trying to identify higher risk companies versus lower risk companies, that we do think about additional models for doing that beyond simply volatility. And based on a lot of Russell research, we basically are settling on looking at measures of quality. So again, this is not an exhaustive list of the types of quality measures that active managers might use, but from an index provider's point of view, this is a really good distillation of the more commonly used variables when people think about how you measure quality. So return on assets or profitability, the debt-to-equity ratio, which is basically leverage, and then EPS variability, which is a company's ability to manage its earnings. All of these factors are combined to create what we call a quality score, and then we do include some trailing volatility scores because we do think there is information in market prices or stock returns, both on a more frequent basis, such as the last 52 weeks of returns, or even a more longer-term basis, such as a 5-year monthly window. So really, we combine the quality and volatility factors to come up with this notion of stability. And again, companies that are have basically better quality and lower volatility are seen as more defensive. Companies that have lower quality and higher volatility are seen as dynamic. And I think one of the things we also try to highlight is these are not just a repackaging of growth and value. So by design, if you look at the variables we're using, those are completely distinct from the variables we would use to define growth and value. And if you look at the outcomes of that methodology, you do get a fairly broad distribution of companies across both the value and growth dimension, the defensive and dynamic dimension. So what you'll see here is all defensive companies aren't just deep value, and all the dynamic companies don't just show up in aggressive growth. You actually have cases where you have companies that are both 100% dynamic and 100% value, and you have situations where companies are 100% growth and 100% defensive. And again, there's lots more research and analysis that could be done here, but the key is we really think we've identified a new dimension in style investing that creates this distinction that investors can use to make active decisions. And so I'll just wrap up there. Again, I won't do a full-blown performance analysis, but one of the things I would highlight here is there are definitely periods where you'll see a very different signal being produced or a different relative performance being produced from the defensive dynamic index than you might see from the growth and value indexes. So in particular, if you look at 2003, you'll notice that dynamic stocks actually substantially outperformed defensive stocks, but in that case, though, value outperformed growth. So you'll notice that there isn't necessarily a consistent pattern year on year. In some cases, you'll have value and defensive going the same direction. In other years, it might be different. I think potentially most significant here, though, is you'll notice in certain years like 2008 and 2009, the distinction between defensive and dynamic is far greater than the distinction between value and growth. So the relative performance is definitely greater in periods where there's either strong down markets or strong up markets. So the relative performance gap is actually much more distinct. And so from Russell's point of view, hopefully this is helping investors address some of these issues that Matt highlighted, where potentially correlations are becoming much more close in the traditional style construct, and now looking at the world across a defensive dynamic dimension can help us make better investment decisions. So that really wraps up the end of my prepared comments. So I definitely look forward to receiving questions and broadening the discussion later on. But at this point, I'll turn it over to Chris.
Thanks, Ralph, and thanks to everyone who's participating on this call. A little background, me and my team are responsible for thought leadership and the creation of equity ETFs at FlexShares. While Ralph explored the ways that you may look at size and style, what I'm going to cover is how to implement size and style investing on a long-term strategic basis in your portfolio. So when we at FlexShares look at size and style investing, and our goal to help investors meet their long-term capital appreciation needs, we still find that a portfolio with additional exposure to small caps and value stocks adds the most benefit on a long-term basis, and this is what I'm going to cover the majority in my presentation here today. Furthermore, we find that the majority of alternative weighted strategies take advantage of these exposures to size and value, and it's chiefly their enhanced exposure to small caps and value stocks that makes these strategies so enticing. So to focus on that first point, why are size and style such effective long-term factors? And to understand why size and value matter, you have to begin with a conversation on markets, risk, and return. I believe markets may not be perfectly efficient, but in general they work. Risk and return are related, and the more risk taken, the more return you should expect. The key is focusing on and investing in risk for which you are compensated. So really it's important to distinguish between what we call systemic and unsystemic risk. And really, when you look at that, unsystemic risk is that firm-specific risk, that lawsuits or fraud or change in management that can really be mitigated away with diversification. And what you find is that you're not rewarded for unsystemic risk, and it's really that systemic risk that is the risk that you're compensated for. And in context of equities, the primary source of systemic risk and that you're compensated for is simply your investment in the equity market. And there's an extraordinary amount of research and advances over the last 60 years in how we view that equity risk premium. You know, starting with the basic tenets of modern portfolio theory, where a combination of risky and quote-unquote risk-free assets are blended to an investor's optimal level of risk and the return level associated with that risk preference. And really what you find is that these concepts have been expanded over the years, first by the capital asset pricing model, where price volatility relative to the overall market is measured by beta, refines that expected returns captured or explained beyond that risky asset paradigm. So really just to kind of speak in layman's terms, what we're looking at here is when you look at the equity risk premium, it's not just simply investing in the equity market, but what CAPM brought out was, as Matt pointed out, that the ability to dial up or dial down by beta by that, price and volatility relative to the market really was the first key driver of expanding just equities versus risk-free assets. And what researchers found was that historically this concept of beta explained 70 to 75% of returns. So if you think about that 70% of the returns were explained by the amount of price volatility in your portfolio on the equity side, while the rest was considered alpha or manager skill. And really, what Fama French did was identify, define, and quantify additional compensated risk premiums to really enhance that. And so what they did was they identified two other risk premia that helped explain those, that size and value are additional drivers of explainable return performance. So whereas like market beta alone captures 70% of the returns, by adding size and value to that equation, researchers were able to show that you were able to boost historically the explainable returns to 90 or greater than 90%. So really that alpha has shrunk from 90% to 10%. So similar to what Ralph was speaking on about viewing small cap managers or large cap managers and their style drift. Really this helped kind of mitigate that and judge people based on what their exposures were exactly. And really the evidence to small cap and value investing is quite compelling. What we've done here is really replicate some of the Fama French research. What we've done is created long-short portfolios where we've created a long portfolio of small cap stocks and shorted the large cap portfolio. And really what we've done is we've examined them over 5-year rolling periods from 1926 until the end of last year. And really what we're looking at here, so if you look at that first bar, is 1926 to 1931, all the way to the far right, which is 2006 to 2011. So when we look at this chart, there's a few things that I view and that we view that stand out. First is the multitude of small cap performance. So if you were to look at, like, say, the number of green bars here versus the number of brown bars, the green bars are when small caps outperform large cap. The brown bars are obviously the reverse of that, where large caps outperform. More often than not, you see that small caps historically have outperformed. Also, the other thing we point out is that the magnitude, that the height of those green bars compared to the depth of the brown bars, that more often than not, on average, the outperformance of small caps is greater than the outperformance of large caps when large caps are in favor. So really that's one of the things that basically that upside capture for small caps in this kind of portfolio really proves out. Now, as they say, there's no such thing as a free lunch. And obviously, as you could look at this chart, there's prolonged periods of underperformance. So if you look at, like, say, the 1950s, the early 70s, you talk about a lost decade, look at those 1950s. And really, this is, some of what Matt, highlighted at the beginning. And some of the things that, when we talk about looking over a 3-year or 5-year window, sometimes isn't the best. That really you have to look over larger time horizons, and that there are periods in time where you've seen small caps underperform for a decade. However, more often than not, small caps have outperformed, and after those underperformance, you do see returns to small cap prevalence, and over time that the small cap outperformance has been a strong performer. We see similar results when we examine value versus growth. Again, just to kind of highlight the methodology here. We're looking at a long-short portfolio where we've gone long value stocks and shorted growth stocks. And again, looking over 5-year rolling periods from 1926 until last year. And we see similar results to what we saw with size. Actually, value is even stronger of a performer than size is. So you see a larger multitude of outperformance of value over growth stocks over 5-year periods. And you see, once again, you see that strong outperformance of value over growth, that the magnitude and multitude are both significantly positive. But once again, you see prolonged periods of either underperformance or flat performance where you would have been agnostic between value and growth stocks. However, when I plot the two charts together, and you can go back and kind of look at these to make sure that everything lines up, but historically what you find is that size and value rarely underperform at the same time. So either, in fact, if you look at this, there's really only historically 4 5-year periods, 4 bar charts, where both value and size are negative at the same time. And logically, when you think about it, that makes a lot of sense when you think about, the risk-on, risk-off trades that we talk about. When there's an appetite for risk increases, small cap stocks are, tend to be outperforming, and at the same time, those value stocks are going to trail growth stocks, and you see the small cap growth performance. Also, when you see those flights to safety, it's those large cap and value stocks that tend to do better. So, in those markets, what you tend to see is those small caps are underperforming. That value side tends to help the portfolio. It's part of this reason why we recommend enhanced exposure to both size and value at the same time, and not just focus on one. I know, when you look at the value chart, it's easy to focus and say, oh, well, it looks a lot better than the size chart in a lot of periods, but, the chief is, we find that the best portfolio is one that focuses on both size and value. Also one of the other things that just kind of side note is what you find is that the deeper you go in size, the better your value premium, especially here in the United States. So they're related a little bit in that way, and so that's one of the things that we find is another reason to combine size and value in one portfolio. And both of these factors are also persistent over longer time horizons. So what we've done here on this next chart is kind of looked at the monthly data, and we examined rolling periods over various time horizons, starting with 1 year, 3 year, 5 year, all the way up to 40-year time horizon. So, for example, we started at July 2006, and on the 1 year we held it to June 1927, and in the 40-year you would start in July 1926 and hold that to June of 1966, and look at each one of those, rolling it month by month to see how often small caps outperformed large cap stocks. And really what you find is over a 1 or 3 year basis, it's really a coin flip between whether small or large cap stocks outperformed. So if you see that on the chart, really over a 1 or 3 year period. So when we talk about, 2007 till today, we're still on that short end of that time horizon where, there's higher correlations in small caps versus large caps, but really what you find is as you go further out over 5-year, 15-year, and beyond time horizons, the more likely that small caps historically have outperformed over time. And you have a greater confidence, a greater probability of that actually happen. We see similar results between value and growth. Actually, because value, like we talked about earlier, is stronger than size in the short term. You see that even in 1 year, there's a 60% give or take likelihood that value outperformed historically. And you see that actually that efficacy of value outperforming growth extends, even more dramatically as you go 3, 5, 10 years. You can see how value investing over growth historically has been a strong performer for a portfolio. And while all the data I've shown here today is U.S. based or domestic based, because really that's the largest window of time and the most amount of data that we could analyze at one point, what we found is that both size and value are prevalent on a global basis in both developed and emerging markets. Fama French actually has done, and they publish returns for their S&B and HML over international developed markets. We've done some research as academic research on emerging markets. We've done some research in-house as well on, size and value in emerging markets to show that prevalence as well. So really those things are not just U.S. based, they're global based providers. So now we've covered the why of size and value and why those are important factors. It's also important to discuss the how. And what I'm not advocating here is for 100% exposure to small cap and value stocks. There's too much volatility, too much tracking error if you go about that, and too much risk. And also, as we pointed out, there's prolonged periods of underperformance. What we look at in practice is to gain additional exposure to size and value while still diversifying across the total equity market. So when we look at it, that's why we're looking at, still when we think back to that unsystemic risk, we are trying to still mitigate that through total equity market while just gaining additional exposure to size and value. So, if you look at to be cognizant of those legacy market-weighted products, when you talk about those, really when you look at them in the prism of size and value, really you get negative exposure to size and value or increased exposure to large cap and growth. And, it's easy to see how a market-weighted scheme gets increased exposure to those large cap names, mega cap names. It also has increased exposure to growth. And, that's a little harder to see. The reason for that is, if you think about it, is for growth stocks, you're willing to pay a higher multiple for each unit of book value, earnings, sales, whatever your metric of choice may be. And because of that higher price, obviously you'll have a larger market capitalization, and that larger market capitalization leads to a larger weight. So really when you look at it in practice, a lot of the market-weighted schemes have that exposure to large and growth away from that small and value. So really the alternative, to excuse the pun, would be a lot of these alternative weighted strategies that are out there today. And really when you talk about alternative weighted strategies, you're really talking about anything outside of the traditional market-weighted framework. So, and there's several, potential benefits and considerations that we talk about when we look at alternative weighted strategies. That ability to access beta exposure while harnessing or reducing biases to valuation, volatility, momentum. We're talking about, I'm talking about valuation and size. Ralph talked about using volatility. You could also use momentum. All these are ways that alternative weighted strategies go about enhancing their models. You tend to find that they have strong in-sample and out-of-sample performance. They have low cost and more transparent compared to a lot of the active strategies that are out there. But they do come with some additional considerations that you have to be aware of. One, you're going to have higher tracking error to the policy benchmarks, like we talked about, with size and value, because a lot of these strategies focus on that. You'll see periods of underperformance in both bull and bear markets. And, a lot of times with the traditional alternative weighted strategies, you'll have higher turnover and higher transaction costs than the typical market-weighted benchmarks. And in some alternative weighted strategies, the strategies themselves lead themselves to sector concentrations that might delve into some of that unsystematic risk that you're not compensated for. And that's one of the things that you want to try and mitigate away when you investigate different strategies. So really what we see is most of the recent innovations we see in the index space have been going along the lines of finding ways to more efficiently capture these factors of size, value, volatility, while offsetting some of the drawbacks of the traditional alternative weighted strategy. And this is where the concept of tilted strategies comes in. Tilted strategies are not a new concept. We're starting to see a little more prevalence in the ETF space. Obviously, we here at FlexShares have some tilted strategies. Other ETF providers, you see it in the mutual fund space. There's other tilted strategies out there. And really just to kind of define what a tilted strategy is and how it differs from the traditional alternative weighted framework is really your starting point is very similar to a market weighted approach, that you're starting with what looks like a market weighted portfolio, only then you're tilting to one or multiple factors, whether that, in this case we're talking about additional exposure to size and value. Other thing to kind of point out is that it's really what I call a nuanced approach. You're not going to over tilt so that you're a large or small cap value portfolio. Really what you're doing is you're tilting slightly to offset the inherent biases to large cap and growth stocks in a legacy market weighted framework. So, when we look at the benefits of a tilted approach, what you find is that you still have that total market ownership. You're going to own non-dividend payers. You're going to own large cap growth stocks. You're just going to own them at a lower weight than if you were to market cap weight the portfolio. You're going to have a consistent level of exposure to size and value over time, and that's really something that's important when we look back and look at that dedicated exposure to size and value. What you want to do is maintain a consistent exposure over time, and that's why it's important not to over dip into value or size as you go through from, look at that time horizon from 5 years, 15 years, 20 years, even over 1 or 3 year basis. And because you're closer to a market-weighted approach than the traditional alternative weighted strategies, you should have a lower turnover and less tracking error than some of the deep value or small cap alternative weighted strategies. And what you see here at the bottom is kind of, I mentioned that most traditional alternative weighted strategies contain explicit or implicit exposure to size and value. In benefit of time, I don't want to kind of go through it completely here, but if you think of an equal weighted approach, obviously, because you're equal weighting, you're going to have less of that large cap exposure. Similarly, you're offsetting some of that growth exposure because you're not paying the same higher multiple and weighting those growth companies the same. One of the other things I just want to kind of briefly highlight here is that, a lot of people deem alternative weighted strategies as quote unquote active management. And really what you find is, what you have to start with is, how do you define active management? And really the traditional definition are stock pickers. If you're starting with a basket of 500 large cap stocks, you're choosing 50 or 100, whether you're going through a fundamental process or a quantitative process. Really the emphasis is on stock selection. And traditionally what you find, the other characteristic of active management is traditionally higher fees. And when we think about it in that framework, alternative strategies don't really fit that description. They don't partake in that stock selection. You're holding the 3,000 largest stocks, holding 98 or 99% of the investable universe, and really any in sample or out of sample excess returns are not coming from stock selection. It's from exposure, factor exposure, and what you find is that your fees are closer to the median with these alternative weighted products than you would find in, say, the semi-active indexes that are out there or the active ETFs that are out there on the market today compared to the relative space. The other definition of active would be to say, okay, anything with a factor bias is an active product. Well, as we covered here today, all indices, whether you're alternative weighted or market weighted, you have some sort of embedded bias in it, whether it's the large cap or growth, small cap or value, to volatility. That factor bias, whatever it is, helps determine that. And what really I'm getting at here is that there's been an evolution of that old alpha beta model, and that's kind of what we're showing on here. Rolf had hit on it earlier with his history chart that he showed throughout it, and really that you see that the model has evolved to include intelligent beta products, whether based on volatility, size and style, whatnot, as part of the investment framework. So there's not just alpha products or pure beta products, but these factor beta products as well. And when we speak to advisors and we talk to various clients, what we're finding is that people are using all three of these. You see a lot of times people will look at their equity core and not just have alternative weighted strategies or market weighted strategies. They'll actually have a combination of both in their portfolios. You talk to people and they talk about their core and explore, where they have a core of market weighted or alternative weighted strategies as their core, and then they'll enhance that with tactical alpha strategies or active strategies around that. So really that's kind of what we're looking at as the paradigm shift and something that we're looking to as the innovation. So I'll just keep it as a quick wrap up here. So I want to actually just turn it back over to Matt. That way we can get to some of the Q&A. I know we have a few minutes left, and I want to make sure we have time for questions. I'm looking forward to it. So thanks for having me. And, Matt, I'll turn it back over to you.
Great, Chris. Thanks so much, and thanks, Rolf, as well. I thought those were two excellent presentations. I'll remind everyone in the audience you're able to ask questions of myself, Chris, or Rolf using the Q&A panel at the bottom right of your webinar browser. But I wanted to touch briefly on the question of global relative weighting for capitalization. You know, Chris mentioned that Fama French extended their analysis, and Northern Trust did as well, to note that the small cap premium exists in developed and emerging markets. And I guess my question for you, Rolf, is when you take that global relative approach, have you done the work? Does the size premium still exist, you know, say throughout all of Taiwan, or do you lose that when you move to a global relative approach on capitalization?
Okay, yeah, sorry about that.
That's all right.
We haven't done any formal research. Again, for us, you know, some of this is just based on, you know, our observations of how, you know, active managers would approach the problem. And so generally speaking, you know, for someone who's truly looking from a global perspective, you generally don't see them defining size differently by country. So, you know, I think one sort of assertion we would make is that, you know, size is truly defined by the capitalization of the company, you know, on a global basis. It's not really a conditional definition based on the domicile of the particular company. Now recognize again, that's from a global investor's perspective. So that is an assertion we make, and we've done some internal work, but we haven't done anything formally that's been published.
Right. Hey, Chris, how would you approach that question of market capitalization weighting on a global scale? If you were building a global tilt product, would you look country specific and constrain that way, or would you look across, you know, the entire global capitalization?
Well, I think that's a good question. And, you know, looking at the research and looking at some of the stuff that we've done in our own internal researches, what you find is that when you look at size, we tend to look at it on a local level or as on a country level. But when you put it into, you know, that seems to be the most that explains size the best. But when you put it into practice, what you have to do is kind of do it either in a top-down or kind of what we look at as kind of almost a hybrid approach, which is you start top down to cut off your large cap versus small cap, but then you fill from a bottom up approach, because when you look at different countries, what you end up with is, you know, Rolf mentioned Taiwan, you know, in the developed market you would say Japan, these countries with very long tails where you have large cap, but then you have extremely large tail small cap companies, and really cutting that off is something that you want to do kind of on a country level, in our opinion, when it comes to capturing the size premium.
Right. I think it's an interesting area of debate. Rolf, I wanted to go back. We don't have that much time, you know, quickly to the concept of defensive and dynamic. From an investor's perspective, how does that interface with the concept of growth and value? Can they both coexist in a portfolio? How do you build a portfolio around those four different ways of breaking up the market?
Yeah, and that's a great question, I think, and that really is now the sort of the next stage of our work is now that we've defined this new dimension, we can identify it as being distinct from growth and value and having very different characteristics and potentially additional diversification properties. That's really work in process to help people understand now how they can combine the two. So we actually are now, you know, launching indexes that are combining the two together. So you will have something like growth defensive, growth dynamic, value defensive, value dynamic. But that is work in process. But again, we do think there are some compelling, you know, diversification and investment benefits from doing that.
Right. Hey, Chris, maybe a question for you is, when you were building the tilt products and you decided to emphasize small and value, those are sort of the classic factors. Did you think about the other factors that folks mention? You know, someone, you know, talks about momentum quite a bit. Others talk about volatility. Did you think about making it a more complex model, and why did you go with the two traditional metrics?
No, that's a good question. Really, you know, we've looked at multiple factors. When it comes to, you know, there is, you know, a lot of academic research out there about momentum. The trick is really implementing momentum into a strategy along these lines. A lot of times you're going to incur a lot of turnover that way. And obviously in what we could consider a core product, we want, that was something we didn't want to have happen. But when we look at some of the other factors, there's, a lot of factors go in and out of favor over time. But what we find is that size and style predominantly are, ones that are persistent over time periods, whether it's, short-term or long-term. And what we find is that really what our purpose was with these tilt products was more on capital appreciation basis. So looking at that goal for clients. Really the way that we look at things is, okay, what are people trying to accomplish by investing in equity markets or into these products? And that's where our framework starts when we build products. Obviously, when you look at defensive dynamic, there's different ways of looking at that, and there's, I think, a lot of compelling research on that end too. Volatility, there's a lot of compelling research there. But I look at volatility more as a risk mitigation tool than a capital appreciation tool over long time horizons. So really what we're looking here to do is create products that were dedicated products that people would be able to use for long time horizons to meet their capital appreciation goals.
Right, and just to be clear, you do consider these, part of the core portion of the portfolio, right?
Exactly, yeah. We consider the tilt products, their total market, we consider these to be equity core products that you would use to fulfill your core portion of the portfolio.
Right. Rolf, I got a few questions on, sort of the index geek side of creating a growth and value index. One question from the audience is why continue to use book value when so much value today is intangible and present in IP and brands? And the second one is, did you look at, rolling debt to equity or ROA into your definitions of growth and value rather than building these dynamic and defensive indexes?
Yeah, great question. Not sure we're going to have enough time to get into a full discussion. I think the short answer to the first part of the question is, despite sort of acknowledged limitations to book value, it still stands as a fairly robust descriptor of value, both across countries and across capitalization sizes. I think it's important to understand that in addition to the signal certain data elements provide from an index provider's point of view, things like coverage and data quality also are things we have to take into consideration. And so book value, on balance, does still provide what we think is a fairly strong signal and is fairly easy to obtain variable. But you'll notice we have added some additional variables, or added additional variable in the form of sales per share growth. Generally that gets more at the growth side, but on balance between the three variables that we use, we still think we get a pretty robust picture. And the answer to the second question is, and maybe I didn't make this clear, is we things like return on assets and leverage are we do see as very distinct from either growth or valuation factors. And so it was important for us when we developed the stability indexes that on purpose, by design, that methodology uses distinct variables, not necessarily affected by valuations. If you, as opposed to just simply adding them into growth value and somewhat, I guess muddying the water, so to speak, combining the signals together.
Right, that makes sense. And quickly to you, Chris, one of the more interesting things you mentioned was sort of eliminating the undiversifiable risks like sector concentrations. Can you talk a little bit more about how much the tilt process does that versus making, say, separate investments in small cap and value? What is the level of constraints there? How much sector concentration do you end up with, and how do you control for that?
Well, really starting with the market-weighted approach, and I'm going to make this really quick. Starting with the market-weighted approach helps mitigate that. When you look at the sectors, you will have obviously some sector overweights or underweights. Really, the way we look at it is we wanted more to have that consistent exposure to size and value. If you were to say to do this with, say, own a total market and then a small cap and a value, those three portfolios, what you find is that the small cap, your exposure to size varies from rebalance to rebalance of that index. Same thing with if you went total market to value, your exposure to value will change time to time, every time. So really what we've done and what our partners Morningstar have done is come up with a way of maintaining consistent exposure to size and value from rebalance to rebalance, so that every time you are getting the same exposure to size and value. And that's really, we find to be the key drivers to the performance and that risk return metric compared to the in essence sector concentrations.
Right. And that's going to do it for us. We've taken up more than our full hour. I'd like to thank Rolf from Russell and Chris from Northern Trust. For more information, you can check out both of their websites. As mentioned, a recording of this webinar, along with the slides, will be posted on IndexUniverse.com within the next few days. As an attendee on this webinar, you'll be sent an email alerting you when those files are open. I'd like to thank the audience for coming and for asking great questions, and again, thank my panelists for their insightful comments. I hope everyone has a great rest of their day and a good rest of your week. Thank you very much.